From uncertainty in Washington to the effects of natural disasters, there's no shortage of risks for financial service stocks to navigate. Joining us now to discuss his outlook for the sector is Kevin Heel, Senior Analyst with Argus Research. And Kevin, welcome to the show for your very first time on MoneyTalk Live.
Yes, thank you for having me on today. Appreciate it.
All right, well, let's set the table. Well, of course, monetary policy is in the news quite a bit lately, and it can have a big impact on the names in this space. Can we get the latest? We do get the latest on U.S. inflation report tomorrow, but what's your outlook for interest rates right now?
Here at Argus, we're looking for continued steepening of the yield curve. We had been inverted for quite a while. We do see some potential cuts in the second half of the year, but look for the longer end of the curve to remain elevated due to the recent tariffs and uncertainty over what's going to happen with the new administration. You have Chairman Powell's in front of Congress today, and indicating that there are going to be a wait and see attitude until it's a little more clear of what's going to happen on government spending and also the DOGE government cuts.
All right, so how does that environment set things up for insurance firms, especially with the recent wildfires that we saw in California? And it's not just California. I mean, we are seeing, challenges in the hurricane-prone regions in Florida and Louisiana. How does that environment set up for the insurance companies?
Well, they're, with the recent wildfires, and we had the hurricanes down in Florida, Georgia, and the Carolinas. Most of the in the U.S., all the insurance rates are set state by state. So we're going to see some, definite inflation in the insurance costs, whether it be auto or home. And Chairman Powell was asked about that question today, and they can't really do anything about that policy. But you've seen a lot of the wildfire and hurricane states, Florida, California, have their own insurance, state insurance, that's kind of the insurer of last resort. But they're probably going to be, I don't want to say bankrupt, but the funds that they have in there will be disappearing quickly and will be called upon by other insurers to buck up. A lot of the major insurance companies, such as State Farm and others, have left these regions. Won't write new policies. They'll continue to write policies, but they often will put in an increase for 15 to 25%, and then end up with an 8 to 9% increase. And that's what's been driving a lot of the U.S. inflation lately, has been the cost of insuring a new home and an auto. So with auto costs going up, price of cars, the price of homes going up, you're seeing a lot of folks get some sticker shock on the costs.
Yeah, and we heard from Chairman Powell, who said that he's in no hurry right now to raise interest rates, and certainly he's probably taking that into account when he talks about interest rate cuts in the future. I want to talk about some of the other sectors that you cover. What's your general outlook for the regional banks in the U.S.?
Yeah, I cover a couple different regionals spread across the country. If rates were to remain unchanged and loan demand doesn't increase, this will kind of crimp bank earnings. So their net interest margin, or NIM as we call it, will potentially decrease, where that spread between what they pay out on deposits and what they're able to earn on loans won't be as high as it had been. If we do get a couple cuts, that will definitely help. That will lower the rate that they have to pay on deposits, and would actually help increase the NIM. But we do expect, like I said, we expect longer-term rates to remain kind of near these levels moving forward, and we'll have eventually a steeper yield curve.
Now, we talked about the Fed cutting interest rates. So, their interest rate policies affect everything from, borrowing costs to refinancing activity. Talk about some of the companies in the mortgage space and how they could be impacted by the Federal Reserve's monetary policy going forward.
Yeah, well, the big thing is most 30-year mortgage rates here in the U.S. are based off the kind of a 7 to 10 year Treasury blend, a lot off the 10-year. So the net effect of lowering short-term rates doesn't necessarily have an effect on the longer-term mortgage rates, but it does help if with a steeper yield curve, you might get folks that might come out of a 30-year fixed mortgage into a 5-year or an adjustable rate mortgage where they can get a lower rate. So it would definitely, any of the Fed cuts would help the mortgage market. But as we saw when the Fed cut rates in the fall, the 10-year has gone from 375 now to about the 450 range. So it didn't have the effect that it wanted on homes. And what we see in the U.S. is that during the go-go times, the homes were seen as a piggy bank, and people were moving up. But now with a lot of homeowners having a 2.5%, 3%, 3.5% mortgage, their next step up, the next move up, obviously they want to move into a bigger house, they have a bigger family, but the costs are quite prohibitive. So we've seen a lot of folks staying in their homes and adding on or building on to them and expanding the previous home. And we don't quite have as much activity in the step-up market for mortgages. So that limits the number of homes that are available to first-time home buyers.
Okay, I also find it interesting, you also cover stock exchange companies, and these companies, stock exchanges at least, have been benefiting from President Trump's pro-growth policies. What's your outlook on these companies, particularly as we've seen, we have seen a bit of volatility recently, but we have seen some strength in a lot of the stocks based on President Trump's policies. What are your thoughts on those stocks going forward?
Yeah, primarily the two stock exchange, NASDAQ and ICE, which is the parent company of the New York Stock Exchange. The stocks have done very, very well over the past year. And a lot of it is a transition to data and analytics. So they're pretty much split on their revenues of 50-50, where it's annualized recurring revenue versus in previous years having to rely upon equity and ETF trades and getting those commissions. So they've transitioned themselves a lot to more on the data analytics side as a way to smooth out earnings and have a lot more recurring revenues. Another stock, CME, I cover, has been performing very well based upon that's where you get betting on the contracts of Fed funds and other Treasury items, and recently have done very well with the new Trump administration's favoring crypto. So that has helped buoy results there. And another one, CBOE, they're primarily known for their VIX index, the equity volatility index. And in times of stress, CBOE does very, very well when the VIX has a lot of volatility in it.
All right. And do you see any risks to some of those markets going forward?
Well, I think the CME, there's less activity going forward if the Fed were to step aside for a significant amount of time. The exchanges seem to have, it's not just the New York Stock Exchange. ICE has, energy, and so there's a lot of when something might not be as good, they have another buffer that could drive some earnings. And I believe the fact that they've, have set themselves up for half of their revenue is from commissions and trading, and the other half is from these data analytics and pricing tool and other engines that they have that are the other 50% of their earnings. So definitely helps provide a buffer.